Okay, so the US government shutting down, and that apparently is helping to hurt stocks today. Let's get perspective from Brenda O'Connor Juanas, Senior VP and Financial Advisor at UBS. Always great to see you. Thanks very much indeed. I know it's just one day, but do you think that's what's weighing on stocks right now, the shutdown?
For sure. Thank you for having me on. Let's take one step back before we talk about this shutdown. It is October 1st. We're coming into this fourth quarter. And I'll tell you what clients are asking about. They're asking about what to do with markets at these all-time highs. They're asking about what to do with cash as rates continue to come down. And they're asking about what to do with risk given this backdrop. I very much think that this is still a narrative about the Fed, even and despite all the market noise, especially related to the government shutdown, which we saw this morning. Look, that is what is causing the disruption in the markets. But we have to remember that historically, these shutdowns don't have a meaningful impact on the economy. Look back to 2019. This was the longest shutdown on record. It shaved off 0.02% of GDP, right? So we have to refocus here on the rate cuts. We've had one in September. We're expecting three more from now until the end of the first quarter. And I think, frankly, Andrew, that is going to be a more meaningful and important part of what moves markets here on in.
Longer term trends, you're speaking to investors. Give us an example of one or two of those, if you would.
So I'm looking at this S&P, and this pullback is a little bit refreshing because PEs are at 22.5 times. That's pretty expensive to me, and I frankly don't care what fundamentals are underpinning this. As an investor, I'm looking at ways and better areas to find value. For the first half of the year, we were looking at non-US stocks, particularly in developed markets, particularly in Europe. And look at those European names. They're up 30% year to date. At this point, looking forward, I'm looking at emerging markets evaluation. From a valuation perspective, they're trading at 14 times plus or minus. And what I think will underpin this outperformance are rates coming down? Are some of these countries adopting these fast-growing technologies? And also look to what's happening with the currencies, right? You see emerging market currencies start to strengthen against that US dollar. We know that these companies not only generate their revenues in local currency, but they report back into US dollar. So as we continue to see that US dollar weaken, which is our expectation for the foreseeable future, those returns back in US dollar or dollar returns are going to continue to look attractive.
When you go around Toronto these days, there's cranes everywhere because we're belatedly building infrastructure, including public transit. But apparently, if you go to Asia, countries like Singapore, parts of India, China, you just see shiny new cities and infrastructure in parts of those regions. You are optimistic, for example, about Chinese tech growth?
Yes, we like China tech growth. I think, again, it's looking for relative value at this point in time. I have clients that are still bullish on the U.S. tech story, as is UBS. We think that the sector will be up, low double digits in 2026. But I also have clients that are not necessarily comfortable stepping into names like NVIDIA at these levels and are looking for other ways to play the theme through infrastructure, through China tech, and also through, those types of things. Like, think about playing this theme through infrastructure. We think that AI CapEx in 2026 is going to be $500 billion. That's just a number that's difficult to comprehend. That's the size of Ireland or Norway's economies. I think that the real potential to outperform here is really in that infrastructure play. It's the picks and shovels approach to investing in AI. I think this is a real bottleneck for the AI sector right now. As utilities and as grid operators continue to try to think about ways to deliver capacity to data centers. So there are ways to play this both in the private and public markets. And that's a slightly alternative way to play tech and the AI theme.
The boomers are beginning to die, let's put it bluntly, the older boomers, but they're obsessed, of course, being spoiled babies. I'm a tail end boomer, with extending our lifespan. You see a big theme there, Brenda.
Absolutely. I mean, I think we're all listening to the same podcast, Peter Attia, Huberman. And look, I think this year in particular, investors seem to have a really short investment horizon, given that we're all fixated on what Powell's saying or what the next Trump administration is coming out with. And so I'm really trying to encourage clients to have a longer term view here, to think about what is really going to drive the economy for the next decade, not the next quarter. We talked about AI already. I think everyone has talked about it ad nauseum. So this whole industry of longevity is something that I'm looking to invest in. Think about longevity as a sector or as an industry is going to be worth about $8 trillion by 2030. $2 trillion of dollars is just with healthcare alone. So putting baskets together that are longer term in nature, that are going to get exposure to subsectors like obesity or med tech is something that I'm really focusing on with clients.
It is interesting. Any particular area of medtech, health insurance as an industry, or pharma?
Yeah, I think obesity and the GLP-1 drugs are an area of focus. Look, we all know about it, but I think in terms of market share, there's still a lot of upside potential to this category. Again, med tech or anything in that diabetes or any sort of chronic condition is interesting. So there are a whole slew of ways that we can play this theme.
We're tight for time, but bonds are back. And you say they're a true portfolio anchor. What do you mean by that, please?
Right. And it really has to do with what cash is doing. The value of cash, the attractiveness of cash is dissipating as rates come down. And so within portfolios, clients are going to need to have an anchor. Gold has proven to be another great anchor this year, but fixed income is always something that I can encourage my clients to have a component of. You know, we're looking at that middle range in terms of duration, that 5 to 7 year. I like investment grade corporates. They're delivering 4.5%, 5% in terms of yield. And I think this is a reliable way to generate income given what is happening to cash, and also relative to other parts of the fixed income markets that I think are pretty risky right now, and think about longer duration treasury bonds as well as high yields. Investors are simply not getting paid to hold high yield bonds given what is happening with corporate spreads.
Brenda, thank you very much for kicking off October for us. Really appreciate it. Brenda O'Connor Juanas is Senior VP and Financial Advisor at UBS.